What is the difference between a first lien HELOC and a traditional 30-year mortgage?
Traditional mortgage is called a closed-ended loan, which means money can only flow in. So you can pay it down as much as you want, but everything is locked away.
If you're going to aggressively pay off your debt, doing it in a 30 or even a 15-year mortgage, like the way that Dave Ramsey recommends, like get a 15-year mortgage, so make the payment higher and then aggressively pay that off and just pray to God that you don't lose your job or get disabled. Oh, that's a terrible situation to be in. Whereas if someone aggressively pays off their mortgage with a first lien, if God forbid something happens, they have liquidity and control.
This is where we kind of start to better understand when it works and when it doesn't work, because it's not a fix-all for everybody. It actually doesn't work for most people. Kind of begs the question of who does it work for? On spreadsheets, on using math only, you could become debt-free faster. Yes, 100%.
Anthony Rushing has dedicated his career
to educating and empowering individuals
to take control of their finances
by strategically leveraging home equity.
The end goal is to help them develop financially so that they become essentially self-sufficient from a business and growth standpoint, where they're leveraging their HELOC to buy cash flow producing assets to help build businesses that are cash flowing to the point where if they wanted to become debt-free tomorrow, they could. First lien HELOC is called an open-ended loan, which means from a money flow standpoint, everything you put toward this to pay the balance down, you can also take back out if you want. If the goal is to create the lowest interest payment possible, then that means we need to just create the most number of days with the lowest balance. That's the big reveal.
Before we get into velocity banking, who it's for, who it's not for, the pros, the cons, I think you have a disclaimer. This lovely disclaimer that you have to say before we get into the fun stuff.
So I work for a bank called First Merchants Bank. I do not represent them. My opinions are my own. They are not representative of the bank. So, if I share things that are opinions, they're not the opinion of the bank. It's of my own. I'm an educator, so our conversation is for educational purposes. It's not financial advice.
Yes.
Disclaimer, right? So all those kind of things. But I want that to be clear, because when I could come out and do these things, it might be perceived that way. I just want to make sure that everyone knows and understands, like, this is Anthony, the person, not Anthony, representative of the bank.
Okay, so let's start from the basics. What is the difference between a first lien HELOC and a traditional 30-year mortgage? Like, talk about basic differences, even before we talk about like the concept of velocity banking and how people are using it.
So if we're comparing a first lien HELOC to a 30-year fixed rate mortgage, the way I like to think about it is they're both first lien position mortgages. Some people, claim a mortgage is defined as a death pledge. The way I like to think about it is a mortgage is just a loan that's secured by real estate. And so being in the first lien position means basically that if you default on the loan, the first position lien holder is the one that gets paid back first. And so a lot of times people like to see it as your initial loan that you get is in the first lien position. If you get another one, it's in the second lien position, kind of on top of the first.
Yes.
That's sort of how it's explained. So both are in the first lien position, but the way that they're different, the two main ways, one has to do with money flow and the other one has to do with how interest is calculated. So money flow wise, your traditional mortgage it's called a closed-ended loan, which means money can only flow in. So you can pay it down as much as you want, but everything is locked away. And so you're unable to take the money back out. It's just how they work. A first lien HELOC is called an open-ended loan, which means from a money flow standpoint, everything you put toward this to pay the balance down, you can also take back out if you want. Obviously, when you take it back out, it increases your balance.
Right.
But it allows for you to have the flexibility to put in as much as you want and take that back out as well. Second difference has to do with interest calculation. So the way that your amortized mortgage is going to calculate interest is it's going to look at the previous month's end balance, and it's going to look at the balance on that last day of the month and use that against your rate to calculate your payment. The way that the right or the type of first lien HELOC that I'm talking about today will calculate interest.
There's a couple different.
Here's the thing.
Is it like the life insurance space, or there's 100 different ways?
Well, I used to say that all first lien HELOCs do it this way. Okay. And I was working for a bank at the point, and they said, well, actually, you can't say that because you don't know if they all do. And I said, that's a good point. So the kind of first lien HELOC that we're talking about here will calculate interest differently. It doesn't look at the previous month's end balance. It'll use what's called the average daily principal balance. So the way I like to think about it is you've got a bunch of days in the month, and each one of those days have individual balances. So if we've got a 30-day month, if we want to figure out the average balance for that month, is you take the average of all those individual balances, and that creates the average balance. So it uses that average balance of the month against the rate to calculate your payment. So so main difference money flow wise is money can go in and out freely.
Right.
From an interest calculation standpoint, it calculates interest using the average balance instead of the previous month's end balance.
And do most first lien HELOCs have a variable adjustable interest, whereas most 15 or 30 years, it's common to have it fixed?
So from what I've seen, yeah. From my perspective, yes. There are ARM mortgages you can get, which are adjustable rate mortgages. A lot of times you'll lock it for 3 years, 5 years, 7 years, and then we'll go adjustable after that. There are first lien HELOCs that have periods of time where it'll lock the rate. Sometimes, at different points in time when the market dictates, you'll have players that enter and they'll come in with a 10-year lock period, that kind of thing.
Oh, so you've
I've seen
10 years locked
I've seen 10 years locked,
on
but
first lien?
yes, but not recently.
Okay.
So a lot of times when markets get extreme, you'll see banks make extreme decisions
Yes.
with their products. So that was around for a little bit when rates started increasing drastically, but it's gone now. So I haven't seen it.
And right now we're recording this May 2026.
It's not available. That's not
how many years can you lock your interest rate for a first lien?
So the thing with first lien HELOCs is that usually they're held in-house, which means banks hold them on their balance sheet. So they have complete control over the guidelines in terms of the risk factors that they implement with it, as well as how they structure the rate. So some banks have a 2-year lock at a certain amount. There's a bank right now that has one for a 6-month lock or a 1-year lock. There's another entity that's planning on doing a 3-year or a 5-year lock. There was a point where we had a 3-year and a 5-year lock. And so in terms of what's available out there, it really is dependent on the banks that are offering at that point. And so it's tough to name a standard because there really isn't one.
I see. And then do most of them right now just change monthly, or could it change daily with the interest rate?
When they're variable?
Yeah. How often can the interest rates change?
So I've seen it as long as 6 months, and then down to a month.
Okay. And is it based on prime? Is it based on
again,
Prime+?
it depends on the bank. So our bank uses the 1-month Treasury bill through the bond market. So that's the index that we use. The way that the rate with the variable rate product, the way that it's calculated is it initially looks at an index, and then it most likely adds a set margin on top of that index. So as the index fluctuates, it adds a set margin on top of that. So the Prime plus 1 is a good example of index plus margin.
Yes.
Prime is just the most popular index that people refer to when referring to mortgages. And so there are bond indexes, there's a LIBOR, there's Prime, multiple indexes. And so it just depends on which one the bank chooses to use as their base index. And so it's really dependent on the bank.
Cool. Okay. So if I had to summarize the difference between like a 30-year fixed mortgage versus a first lien, there's a couple differences. Number one is from a cash flow perspective, your money goes into the mortgage on a 30-year mortgage and it's not coming back out.
Correct.
Like you would either need to refinance or sell to get that money out.
Correct.
If there is built up equity. Whereas a first lien, it's how did you call it? It's a
Open-ended.
Open-ended.
Mm-hmm.
So you can put money in and then have the option to be able to take that money out.
Correct.
Obviously, it's not free. It's going to include extra interest if you have a greater balance,
Right.
but you have that flexibility. And then the other big difference is, I know you mentioned the interest rate. The big difference for me is the 15, 30-year fixed.
Mm-hmm.
There's a potential value of having it fixed versus the variable. Obviously, there's probably in history that the variable was very attractive, but with having variable, especially if it can change, it can also increase.
Yep.
And then the other thing is most banks are selling their 30-year notes.
Yep.
Because it's like no banks, especially with the low interest rates, would want to keep a 30-year mortgage on their books. And is it typical that most banks keep in-house first liens? Like, is that typical, or is that just your guys' bank? Like,
That
how
is
how common is that?